Good afternoon. Welcome to another episode of SRT Live. I'm your host, Sean, with the Sean Richard Mortgage team. And our topic of today, are we going to see inflation come down? Gosh, I feel like this has been the topic each and every week over the past number of months, but I think we're going to start seeing some movement. I think it's going to budge. So thank you so much for joining me on SRT Live. Again, Sean with the Sean Richard Mortgage team here at Guaranteed Rate. Glad to be with you on this fine Tuesday and bringing you economic, housing, real estate, mortgage news and data. So that way you can have better conversations with your clients if you're a real estate agent. And if you are a homeowner or home buyer, you are more educated as you go out into the marketplace and make decisions on home buying and the nature of your home as a homeowner. All right, so let's get in. We're talking about a lot of different topics today. And so this week, actually, I'm going to start with this week thus far, because we haven't really had much data. It's been a very quiet week in the news and economically, but that is about to change. So bond markets were closed yesterday. And so primarily how that impacts us is mortgage bonds or mortgage-backed securities were not traded yesterday. So we saw no movement in pricing yesterday. Today, obviously, that shifted. And then we've got no major economic news today that's really of major relevance. With that, let's dive into last week, because we got some pretty significant news last week. We got the JOLTS report, JOLTS, and the JOLTS report is the report indicating the number of job openings. And this is an important report because this kind of gives us a pulse on the labor market. You know, we always talk about the unemployment claims, and we're going to get into that today as well. But the JOLTS report is the number of job openings across the country. And so if we have a significant number of job openings, that typically means that we've got a robust employment or labor market. We've got a lot of employers hiring. We maybe even have a shortage of labor, of quality labor for the jobs. So we have a lot of job openings. But if we start to see that job opening shrink, then that could tell us something that we kind of already have guessed at, is that we're likely moving into an economic environment where employers are starting to cut down on the new job openings, looking to retain the employees they have and or reduce their staff. So the JOLTS report from last week came in at just a hair over 10 million job openings, 10.053 to be exact. And this is down significantly. This is down about 6.2% from the previous reading of 11.17 million. Now, one of the things that we may want to kind of take into consideration when we're looking at these numbers is our current labor or workforce scenario, or the nature of the environment that we live in nowadays. With the pandemic came a significant amount of work from home. We always love that WFH acronym nowadays. And so what you see is companies that are posting jobs across different markets. No longer does a company in Dallas-Fort Worth necessarily need to hire someone in Dallas-Fort Worth. They're in Florida. They don't necessarily need to hire somebody in Florida. And so these companies are posting duplicate job reports in different markets. And so I think that could be part of the reason why we're seeing the decrease at such a significant pace in the job openings report, the JOLTS report, because when a company's got a job opening posted in, let's say, 2, 3, 4 different markets as separate job postings, well, guess what? If they close that position, it's not just one job opening that goes away or one job posting. It's now 2 or 3 or 4. And so it caters to a bigger decline in job opening. So it's possible that job opening number is still inflated with openings posted in multiple markets. So we got that report last week as well. We also got our weekly jobless claims, and this is unemployment claims. So for those of you watching for the first time, it's made up of 2 different reports. Initial claims, which is individuals filing for unemployment for the first time, and then continuing claims, which is individuals renewing their unemployment benefits. So initial claims came in at 219,000 for the week. And this was much higher than expected. The expectation from market analysts was that this was going to come in at 200,000 new claims filed. The previous was 190, so we're seeing a tick up after we've seen numerous weeks of ticking down. If you remember, earlier in the year, we saw the jobless claims coming in the 250,000 range, and now we've seen them decline, decline, decline. We got under 200,000 last week. Now we are ticking back up. So as always, something important to watch, because this tells us what we're seeing in the labor force as well. Are companies laying off more employees? The continuing claims actually ticked up a little bit as well. We went from last week's reading of 1.346 million to this week's reading of 1.361 million. So right about 16,000, 15,000 increase in continuing claims. I would call that relatively similar, but we are seeing a little bit of a tick up. So we want to watch that to see if that turns into a trend. Now, last week, we also got the massive BLS Jobs Report. This is BLS, the Board of Labor and Statistics here in the US. And the jobs report did not disappoint. Market analysts were expecting 250,000 new job creations for the month of September. We got 263,000. And you might think, oh man, that's fantastic. That's great news. The labor market, the employment market is super strong. And that's awesome, right? Well, hold that thought. Because we saw the jobs report come out at such significant strength, it's likely not going to deter the Fed from their current aggressive stance on inflation. If the job market were clearly weakening, then the Fed, the Federal Open Market Committee, may be able to look at the market and say, you know what? We've been raising the Fed funds rates for a while, and okay, now we're starting to see the fruits of that labor, so we need to slow that down a little bit and wait to see if this continues to drive inflation down to help the economy. And so by getting that 263,000 number, by getting that beat on the new job creations, that basically gave a signal to the Fed that, hey, what you've done so far is not sufficient, and you're going to need to continue to be aggressive. And the market does not like that. When the Fed raises those Fed funds rates, it increases borrowing costs for short-term lending, such as auto loans, businesses, credit cards, and it drives all of those costs higher. Well, guess what? When it costs businesses more money to borrow money, then that cuts into profitability. When that cuts into profitability, market forecasts start to come down, and investors start to cut targets on companies and stock prices. And so it hurts the market overall in this particular case. So although it's nice to see job creations at a healthy number, in this particular instance, it definitely put us in a position where the Fed is likely to continue being aggressive towards inflation. We also got the unemployment rate. Unemployment rate actually dipped down. It surprised the market analysts. Expected to be 3.7%, which is where it was the prior month's reading, came in at 3.5% on the unemployment rate. So again, just one more data point that tells the Fed, hey, what you're doing isn't taking hold yet. And that really concerns the market. Now, that was last week. And if that wasn't enough crazy market moving information for you, we've got another gang busting week this week. So tomorrow we get PPI, which is Producer Price Index. This is an inflationary report at the wholesale level. We also get the meeting minutes from the most recent Federal Open Market Committee meeting, from the Fed meeting. Now, the Fed meeting minutes gives us more insight into what the Fed is looking to do, into their mindset. As of right now, the Fed's looking to be extremely aggressive to bring down these 40-year high inflation levels. So the meeting minutes have a very big possibility of being a market mover. We also get a bond rollover. So mortgage bonds are finite. They are 30-year bonds. And so every month we get a bond rollover, meaning a bond issued 30 years ago expires, new bonds are issued. So every month we get a rollover of those expiring bonds. We get that tomorrow as well. not so much a market mover, but it is something that I'll be paying attention to see what the demand is for those bonds. And then on Thursday, we also get jobless claims, as we always do, but we also get CPI, Consumer Price Index. And so this is the inflation report at the consumer level. This is going to be very much in the crosshairs because this is going to tell us how inflation is moving. Now, the downside, CPI is a 12-month rolling average. And so every month when a new reading comes out, a month over month reading, we drop off the reading from 13 months ago. Well, September of 2021 was a very low inflation reading, 0.3% month over month. The concern is that if we get a similar or higher reading for September of this year, then we could see inflation tick back up, which is not what we want to see if you're a home buyer or a real estate agent, because that's going to mean inflation has still not peaked or is not coming down at the level we'd like it to. And that's going to continue to drive interest rates higher and probably put a damper on the stock market. So that's Thursday. Then on Friday, we simmer down a little bit and we get the University of Michigan Consumer Sentiment Report. This is a survey of consumers gauging the economic outlook. And so this has been taking a hit recently, as expected, since we are on the outlook of heading into a recession if we're not already in one yet. So that's what we've got coming out the rest of this week. Tons of information that has the potential to be very much market moving. That being said, mortgage rates are in a position to be extremely volatile this week. So if you're a real estate agent, when working with buyers, make sure that they're having conversations with their lender about what to expect this week. And if they're not working with a lender that can have that conversation, you can always give them my number right here below. Happy to have that conversation with them. If you're a home buyer, make sure that you're having that conversation with your lender. And if you're not, and they can't have it with you, give me a call. All right, so what are we watching going forward? As always, I want to share the key focuses that my team and I are watching heading forward as we gauge where we're heading as not only economy, but a real estate and mortgage market. So first and foremost is we're watching mortgage rates. We're focused on it. We've got, in my opinion, another 30 to 45 days of pain before we start to see relief. I expect inflation this week to show that it's not coming down just yet, which is going to put the Fed on a path for continued aggressive stance, more Fed rate hikes. And I think that we're going to start to see some inflation decline once we hit the November reports. So November report is for the month of October. And then, of course, December for November. I think we're going to start to see that come down right at this tail end of the year. But until then, I think we're going to see inflation remain high, and that's going to continue to pressure mortgage rates higher or to stay at the same levels. We're also watching inflation. We've got CPI and PPI both coming out this week. Those are important inflation reports for September of this year. And so we're going to keep an eye on that to see what inflation is actually doing. And then again, I talked about the Fed's aggressive stance towards inflation. The Fed's going to be meeting again in November, also in December, and we're expected to see rate hikes at both of those meetings. I think the consensus is 50 basis points in November and 25 basis points in December. That could always change based on the data, but that's the market expectation at the moment. And then lastly, consumer education is so critical. There's a lot of news out in the media that is providing misinformation or disinformation. And it's very much, they're painting a picture of doom and gloom in the housing market. And although we are seeing some shifting in the market, we're seeing, the occasional price reduction. We're seeing some seller concessions occasionally. Overall, we're still appreciating year over year. We've seen some short-term month-over-month numbers in the housing market show home prices coming down just a tiny bit. I think the last reading was a negative 0.3. But that just tells me that home prices are starting to plateau a little bit, which is exactly what we would expect or what we want to see heading into recession. Almost every recession since 1960, home prices have either plateaued or continued to rise through recessions. And I think we're going to see more of a plateau in our current recession. But it's important, if you're a real estate agent, to help consumers understand the market and the economy so that way you can help them make better decisions. Important that you take a consultative advisory approach in this market. Information is critical. Educating about the economy, understanding why the housing market and the mortgage markets are doing what they're doing is really, really important. So that's the approach that I'm recommending that you take with your clients. And if you're a home buyer, make sure you're having those conversations with your real estate agents. If not, reach out to my team and we can make sure that you're having those conversations and understanding that market. Now, I'll leave you with this. If you're a real estate agent and you are in the DFW Metroplex, I would love for you to come out to our real estate town hall event, How to Thrive in the Current Real Estate Market. It is going to be fantastic. We're going to be talking about real estate industry, mortgage, the economy, how everything relates to our industry and our business. So would love to have you come out. It's going to be on October 27th. For more details, leave comments below, or you're welcome to give me a call or a text on my number there. Would love to have you out. This is a free event. We're going to be providing lunch and giving you tons of great information so that way you can go out and have better conversations with your clients. All right, gang, another Tuesday is in the books. I really can't thank you enough for being part of the Powerhouse Real Estate community. If you're watching on Powerhouse Facebook group, if you're watching on YouTube, thank you so much for being here. Make sure that you smash that subscribe button so that way you can get up-to-date real estate and market information at your disposal and at your fingertips. Again, I am Sean with the Sean Richard Mortgage Team. Thank you so much for joining me on this episode of SRT Live. Have an incredible rest of your week.